Here's the truth about retirement. It isn't about hitting an arbitrary $1 million number. Being able to retire simply means that you have enough in savings to cover the difference between your retirement income and your retirement expenses. This number is unique to you and it depends on your personal financial situation. In this video, we will walk through how to calculate your retirement number, and it might be completely different from what you expect. I'm Greg Meyer, Certified Financial Planner and CPA. In over 18 years of helping clients retire, I've watched people stress about whether they have enough, only to discover that their retirement number was actually very different from what they had thought. Many times, people discover that they are able to reach financial freedom or retire years earlier than they expected. Let's walk through how to calculate your real retirement number together. The first step is to determine what retirement actually means to you. What age do you want to retire? Will you stay in your current location and just stop working? Or will you move somewhere completely different and completely change your lifestyle? Will you travel more? Your vision of retirement is crucial because it will have a significant impact on your lifestyle costs in retirement. Once you have a sense of what kind of lifestyle you want to have in retirement, the next step is to estimate what your annual spending number is. If you're within 10 years of retirement, look at your current spending and use that as a baseline. There will likely be some changes when you retire, such as reduced commuting costs, maybe you'll travel more, and healthcare costs, especially if you retire before getting on Medicare at age 65. But from my experience, people generally tend to spend less in retirement outside of potential larger travel expenses. Life often slows down a bit and you don't have to pay for as many conveniences that you did when you were working and or raising a family. If retirement is farther away, then you may have to estimate a bit to determine what expenses will look like in retirement. A good rule of thumb is to plan for 70 to 80% of your current expenses to continue in retirement. But if possible, it's usually best to run the numbers based on your ideal vision for retirement. Once you have a good sense of what you want to spend in retirement, the next step is to determine how you'll pay for this. Most people have some form of retirement income. This may consist of Social Security, a pension, if you're extremely lucky, rental income, or even part-time work. It's important to keep in mind that this income will be taxed. Typically, the tax rate you pay in retirement will be lower than what you paid while you were working, but it's still important to factor in taxes since that impacts the amount of take-home spending ability that you have. As an example, if your combined income puts you in the 22% tax bracket, that $50,000 of income becomes about $39,000 of spendable cash. The difference between your spending needs and your retirement income is the investment gap. Or put another way, it's the amount of money that needs to come from your portfolio each year to cover your living expenses. Let's look at an example. Assume your annual spending goal is $80,000. Your after-tax income from all of your sources is $35,000. Your gap, or the difference between the two, is $45,000 per year. This $45,000 is what needs to be covered from the portfolio. The amount you can withdraw from a portfolio each year to cover the investment gap depends on your age when you retire. The rules I use with clients are, if you're over 65, you can withdraw 4% of the portfolio. If you're retiring in your early 60s, then you can withdraw 3.5%. And if you're retiring in your 50s or younger, then you can withdraw 3%. The 4% rule has been tested through academic studies to be a safe withdrawal rate for a 30-year time period. So someone retiring at 65 has a very high likelihood of being able to sustain a 4% withdrawal rate from their portfolio over the rest of their lifetime. As you retire earlier and have a longer time horizon for your portfolio to support, you need to be more conservative with the amount you take out each year. The withdrawal rate concept here is simple. The total return of the portfolio minus inflation that happens every year equals your withdrawal rate. This allows you to maintain the value of your portfolio on a real or an inflation-adjusted basis going forward. As an example, a globally diversified portfolio earns an average rate of return of 7% per year. Inflation has historically been 3% per year, so the difference of 4% is the real or inflation-adjusted return of the portfolio. This 4% is the amount that you can withdraw each year while still allowing the portfolio to keep pace with inflation. One common misconception that I hear all the time is that the portfolio has to earn enough cash flow from interest and dividends to cover that investment gap. Oftentimes, people only want to live off of their earnings of the portfolio and they don't want to touch the principal. But I don't believe that's the correct way of looking at it. Instead of focusing on yield or cash flow from the portfolio, you want to focus on total return. Total return being the yield of the portfolio plus capital appreciation. This is important because if you just focus on cash flow, then you will have a portfolio that is over allocated to investments that pay high interest rates or have high dividend distributions, but may have much lower growth potential. This is not only tax inefficient because you have to pay taxes on those dividend and interest distributions each year, but it can also be a hindrance to portfolio growth in the long run. Once you know your investment gap and withdrawal rate, then you are able to calculate your retirement number. This is the amount that you need to have in investments to support your retirement. The formula is simple. Annual investment gap divided by your withdrawal rate as a percentage equals the investment balance that you need to have in order to retire or be financially free. For example, if your spending gap was $45,000 per year, remember that's the difference between your spending needs and your retirement income, and you retire at age 65 with a 4% withdrawal rate, then your portfolio would need to be $1,125,000. That's $45,000 a year divided by 4%. When you run the numbers, many of you might realize that you already have enough to cover this gap, maybe years earlier than you expected. And here's the beautiful part. Financial independence doesn't mean that you have to quit your job tomorrow. It just means that you now have choices. Maybe you take that lower paying job you're passionate about. Maybe you start that business you've been dreaming of. Maybe you negotiate remote work or you go part-time. When you're not desperate for every paycheck, you can prioritize fulfillment over just paying the bills. For younger people who have been good savers but aren't quite ready to fully retire, there is a concept that they can utilize called Coast FIRE. FIRE standing for Financial Independence Retire Early. The concept of Coast FIRE is that you can calculate the amount of money you need to have in investments today that will allow you to stop contributing to retirement and let that balance grow through compounding returns so that when you do retire, there is enough money in that account to support your retirement. This allows you to take a job that just covers your current expenses without worrying about adding an additional penny to savings. This can provide complete career freedom decades before traditional retirement. Next week, I'll have another video going into more details on CoastFire and how you can make this work for you. Once you retire, you can turn those savings into a cash flow system just like you have with your paycheck. The best way to do this is by setting up monthly distributions from your investment accounts to your bank account to replicate that paycheck that you're retiring from. Part of these distributions will come from interest and dividends from cash flow, and part will come from selling down assets over time. This combination of distributions from selling assets and from cash flow helps keep your portfolio diversified over time. You also want to be cognizant of the accounts that you pull money from. Distributions from brokerage accounts or trust accounts are not taxable, but interest, dividends, and capital gains earned in that account are taxable in the current year. But this applies whether you take distributions or not. Distributions from a traditional IRA or a traditional 401k are taxable in the year that they are withdrawn, and distributions from a Roth IRA or a Roth 401k are tax-free. You want to create a strategy that balances distributions from your various accounts to minimize the tax brackets you are in, both in the current year and in future years, as required minimum distributions or RMDs and Social Security start. Retirement planning doesn't end when you retire. Every quarter, you should review the plan and check if things are on track. Are your portfolio withdrawals on track for what you had budgeted? Portfolio performance can vary, but keeping track of the long-term returns helps you understand if returns are enough to cover inflation plus withdrawals. Are there any life changes like health or family goals that you need to account for? Here's what I want you to remember. Your retirement number isn't about impressing anyone. It's not about hitting some arbitrary milestone. It's simpler and more personal than that. What you spend minus what comes in divided by a safe withdrawal rate based on your age, that's your retirement number. And for most people, it's actually lower than they think. The key is starting with your real life, your expenses, and your real goals, not some one-size-fits-all formula. If this framework helped you see retirement planning differently, please hit the like button and subscribe for weekly tax and retirement strategies. And tell me in the comments, what was your biggest aha moment from this video?